Stop right there. If you bought silver in the last 2 weeks, you're down 30 to 35%. But here's what nobody's telling you. You didn't lose because silver crashed. You lost because you didn't understand what was actually happening in this market. And right now, while you're watching the ticker flash red, the second opportunity is setting up. But this time it's different. This time, the fundamentals have completely changed. The paper market and the physical market have divorced. And if you don't understand this divorce, you're going to miss the biggest move of the decade. In the next 15 minutes, I'm going to show you what really happened on January 30th, why paper silver crashed 31% while physical premiums exploded 54%, and exactly where the next move is coming from. Stay till the end because the last 3 minutes contain the action plan that could save your portfolio. Let's get into it. January 30th, 2026. Silver fell from 121.78 to an intraday low of 71.20. That's a 41% drop in a single session. This was silver's largest one-day drop in more than 40 years. Not since the Hunt brothers' collapse in 1980 had we seen anything like this. Bloomberg called it silver bubble bursts. Goldman Sachs said it was overdue. The Financial Times wrote it off as speculative excess being purged. But here's what they didn't report. While paper silver was crashing in New York, physical silver in Shanghai was trading at premiums exceeding 50% over the COMEX price at the crash low. Let me say that again. In Dubai, wholesale premiums reached 18%. In Mumbai, dealers were quoting 25% above screen price. At the exact moment when paper silver printed $78.12, the lowest tick of the crash, physical silver in Asia was changing hands at prices equivalent to $120 to $130 per ounce in wholesale markets where actual metal was delivered. This is the opposite of what should happen when an asset is genuinely overvalued. When a real bubble bursts, holders rush to exit. Physical markets should trade at discounts to paper as metal floods the market. Instead, physical premiums widened by 13% to 54% during the very session that was supposed to prove silver was overvalued. This isn't a crash. This is something else entirely. So what actually caused this? The mainstream narrative says margin hikes, leveraged speculators getting liquidated, Kevin Warsh Fed chair appointment. That's partially true. But it's not the full story. Let me break down the real mechanics. As the market hit record highs in late January 2026, the CME increased the margin requirement on silver from 11% to 15%. What does that mean? It means if you were holding silver futures with leverage, you suddenly needed to deposit more cash into your account just to keep your positions open. This forced highly leveraged speculators to either pour massive amounts of capital into the system or close out their positions instantly. Most chose to close immediately. Currently, margin requirements are at 60%. They've been raised multiple times since December. With the Chinese Lunar New Year approaching in mid-February, a further reduction in Chinese speculative money resulted in thin markets with extreme, unpredictable price action. The Chinese New Year break runs from February 16 to February 23, 2026. For weeks, Chinese speculative capital had been driving prices to levels far above what the physical market could support. When that capital pulled out ahead of the holiday, liquidity evaporated. The Trump administration nominated Kevin Warsh as the next Federal Reserve chair. Market speculation ended with the nomination of Kevin Warsh as the next Fed chair, signaling a potential shift in U.S. monetary policy. Warsh is an inflation hawk. Markets had expected Trump to pick someone dovish who would print money and keep rates low forever. When Warsh got nominated, the dollar strengthened. And when the dollar strengthens, commodities priced in dollars fall. Friday's sell-off occurred on the final trading day of the month. This is also a key settlement period for many paper contracts. Position adjustments or forced liquidations may have added pressure to prices. Thin liquidity, month-end settlements, margin calls cascading. It was the perfect storm for a flash crash. But here's where it gets interesting, because what we're witnessing in 2026 isn't just a crash. It's a structural breakdown of the entire silver pricing system. For 50 years, the price of silver has been discovered in the futures markets of New York and London. Paper contracts on COMEX and LBMA set the spot price that the whole world uses. But that system is breaking. The paper-to-physical ratio has surged to 528 million ounces of paper exposure to 113 million ounces of physical silver. That's 4.7 paper claims for every 1 ounce of physical silver. Think about that. There are almost 5 people holding contracts that say, "I own silver," but there's only 1 actual ounce in the vault. This works fine, as long as nobody asks for delivery. Here's the problem. Between early and mid-January, in just 7 days, 33.45 million ounces of silver were physically withdrawn for delivery from COMEX. That meant roughly 26% of COMEX's registered inventory disappeared in a single week. Open interest in the March 2026 contract remains between 85,000 and 91,000 contracts, representing a theoretical delivery obligation of 425 million to 455 million ounces. Even if only 20% of open interest demands physical delivery, a conservative estimate, COMEX lacks sufficient physical metal to fulfill its obligations. They don't have the metal. When the futures market falls into deep backwardation, the message is crystal clear. Silver you can take delivery of right now is far more valuable than silver promised months in the future. Psychologically, this price pattern is equivalent to the market telling every participant, "I'm not sure there will be enough silver to hand over in 3 months' time." This is not normal. And then came the knockout punch. On January 1st, 2026, China, the world's largest refiner of silver, implemented strict new export licensing requirements. This move effectively ring-fenced nearly 65% of the global refined silver supply for domestic use, leaving Western markets in a desperate scramble for remaining stocks. By restricting exports, China is effectively saying the rest of the world can no longer rely on Chinese refined silver to plug its deficits. The supply just got choked off. Now here's why this matters for you. Because while speculators can get shaken out by margin hikes, industrial buyers can't stop buying. Unlike jewelry, which consumers might forgo if prices rise, silver is an essential component in modern technology. There is no known substitute for silver's conductivity in high-end AI chips or solar cells. The photovoltaic industry consumes over 230 million ounces annually. Every solar panel needs silver. There's no substitute. As the world transitions to green energy, this demand is structural and growing. Silver is critical in AI server racks, 5G components, and next-gen semiconductors. Tech giants are now forced to compete with financial speculators for a dwindling supply of metal. This has created a feedback loop where industrial panic buying drives physical premiums higher. The global silver market has run in deficit for 5 consecutive years. Industry estimates suggest cumulative shortfalls of roughly 820 million ounces between 2021 and 2025, nearly equivalent to a full year of mine production. The Silver Institute documented an ongoing structural deficit for 2026, with industrial demand remaining at record levels. There's simply not enough silver being mined to meet demand. On January 28th, Fresnillo, the biggest global silver miner, cut its 2026 guidance to 42 to 46.5 million ounces from 45 to 51 million, citing operational phasing and a shift to narrower, lower-grade veins. Meanwhile, Hecla Mining, another big producer, plans production of 15.1 to 16.5 million ounces, below 2025 output. Miners are producing less, not more. So where does that leave us today, February 10th, 2026? Silver is trading around $81 to $86 on paper markets. Major support levels are in the $69 to $70 per ounce range, while resistance levels are at $82 to $84 per ounce. If bullish momentum continues, silver has the potential to break $85 or more. Currently, the price is at $86.50, which is the decision zone, while the 100-day SMA is at $96, which acts as resistance. Technical analysis indicates immediate support at $83.10, with potential resistance around $90.46 and $96.19. We're sitting right at a decision point. The setup favors continued upside in 2026, targeting $100. A break above $100 will open the door towards $250, $300. Forecast silver reaching $100 to $200 by early Q2 2026, linked to long-term fiat currency debasement and potential equity market weakness. CME year-end target of $91. Key resistance levels include 87.54, 92.68, 96.94, 101.64, 105.90, 109.98, 114.46, 119.14, and 124.54. The consensus range is $85 to $100 in the near term, with potential for $150 to $200 if the physical squeeze intensifies. Many now view prices above $100 per ounce in 2026 as increasingly plausible, not as speculation but as a consequence of structural realities. The difference between now and the January rally? In January, it was speculation and leverage driving the price. Now, the physical market is genuinely tight. The fundamentals have caught up to the price action. If you are buying physical silver for long-term holdings, paper price pullbacks driven by margin-induced liquidation can offer attractive entry points because the underlying physical market remains tight. All right, here's your action plan. If you're currently holding silver that you bought above $100, do not panic sell into paper market weakness. Physical silver is regarded as far more valuable than what Western paper prices currently reflect. In effect, the physical market is asserting price leadership over the paper market. Your physical silver is worth more than the ticker shows. Support to watch is $69.70. Current price is $81.86. First resistance is $90.96. Breakout level is $100. A base long-term scenario is to open long trades above the key resistance at $87.54 with targets in the $92.68, $124.54 range over a 12-month horizon. If silver holds above $80 and breaks $87.90 with conviction, the next leg higher is starting. If any retracement occurs toward the $30-50 range, it would likely present a long-term buying opportunity for investors. This region is considered a key accumulation zone, but realistically, with China's export restrictions and the physical shortage, a drop to $30-50 seems unlikely. More realistic is building positions on dips to $75-80. A bearish scenario remains possible if the US dollar strengthens or investors shift their focus to high-yield assets, causing silver prices to drop to the $60-70 per ounce range. An alternative long-term scenario is to open short trades below the key support level of $81.51 with potential targets in the $76.45, $47.98 range. If we break below $80 decisively, we could see a retest of $70 or even $60. Despite short-term volatility, long-term demand from industries like solar and EVs may support silver prices. The fundamentals support higher prices over the next 12-18 months. If you're buying silver as a long-term hold, buy physical. In a fragmented market where physical metal increasingly dictates price, relying on paper claims introduces risks that many investors have not fully considered. If COMEX can't deliver, paper contracts settle in cash. You get dollars, not silver. But if you're trading shorter term, futures and ETFs are fine for speculation. Let me leave you with this. The paper market and the physical market have divorced, and the implications of that divorce will define precious metals investing for the next decade. What you witnessed on January 30th wasn't just a crash, it was the birth of a new market structure. For 50 years, Wall Street controlled silver prices through paper derivatives. That era is ending. The current 60 per ounce gap between paper and physical suggests that this era of paper discovery is coming to an end. Markets where physical demand is stronger, such as Shanghai, Hong Kong, and other Asian hubs, will gradually build out an alternative pricing network that competes with the dollar-centric system. The first opportunity? You might have missed it, or maybe you got caught at the top, but the second opportunity is setting up right now. This time it won't be driven by speculation and leverage. It'll be driven by industrial necessity and supply scarcity. The question is, will you understand it this time, or will you watch from the sidelines again? The choice is yours. If you found this valuable, hit that subscribe button. Drop a comment below with your silver position. Are you holding or buying more? And I'll see you in the next one.